Ever wondered why smart people make poor financial decisions? Yes, it's a conundrum that has puzzled many. Enter behavioral finance theory, a fascinating field that merges cognitive psychological theory with conventional economics. It aims to demystify the seemingly irrational financial decisions that individuals often make. Consider this. Traditional financial theory advises buying low and selling high in the stock market. Yet many investors do the opposite. They get swept up in the euphoria of a bull market and buy when prices are inflated. Then, during a market downturn, panic sets in and they sell at a loss. Doesn't make sense, right? Well, behavioral finance theory suggests that these decisions are not merely random mistakes. Instead, they are influenced by cognitive biases and psychological factors. It's not just about the numbers, but also about our perceptions, emotions, and beliefs. So it's clear that our decisions aren't always as rational as we'd like to think. But can examples from real life give us more insight? Let's delve into the fascinating world of real-life case studies that illustrate behavioral finance theory. First, let's rewind to the late 90s, a time when the internet was still a budding phenomenon. This was the era of the dot-com bubble. Investors were swept up in a wave of irrational exuberance. They poured money into internet-based companies, many of which had no solid financial foundations or even a clear business model. Two cognitive biases were at play here. Overconfidence made investors believe they could predict the future of these tech startups, while herd behavior led them to follow the investing crowd, regardless of the lack of financial sense it made. Fast forward to the 2008 financial crisis. This was a time when loss aversion, the tendency to prefer avoiding losses rather than acquiring equivalent gains, kicked in. Financial institutions and individual investors held on to assets with plummeting values, hoping the market would bounce back. Anchoring bias, the tendency to rely too heavily on the first piece of information encountered when making decisions, led to poor decision-making. Investors anchored their decisions on the high asset prices before the crash, failing to adjust sufficiently to the new market reality. These case studies show us how cognitive biases can lead to irrational decision-making on a massive scale. What can we learn from behavioral finance theory then? Well, it's crucial to acknowledge that our cognitive biases influence our financial decisions. By understanding these biases, we pave the way for smarter, more rational choices. Behavioral finance theory is an expanding field, offering invaluable insights not just for investors, but also financial advisors and policymakers. Remember, recognizing our own biases is the first step towards making more rational financial decisions. Until next time, keep questioning your decisions and stay financially savvy.